Hi, in this video, we're going to go through the income statement. The income statement, or sometimes it's called the statement of operations or statement of earnings, reports the company's profit during a particular reporting period. Here we have an example of an income statement, typical income statement, where you see the company's name, the name of the financial statement you're looking at, and the time period that the income statement is covering. In this example, for the entire year ended December 31. Typically, when you see financials, you'll see at least 2 years worth of income statement information, the current year and the prior year. It starts with the income from continuing operations, which we'll get into, and you have your revenue minus your cost of sales equals your gross profit. You have a subtotal for gross profit. And then you go into your operating expenses, which are your day-to-day expenses that you need to run your business. So here we see selling expense, G&A, R&D, restructuring costs, which is an operating expense. And then we have total operating expenses. Then next we have what's called operating income. We have like the net operating income, which is the 618 minus the 451. Then we have other income and expenses. These are not. Then we have other income and expenses, and these are typically items that are from our non-core operations activities, such as gain on sale on investment. Any interest revenue or expenses is also considered not to be part of the day-to-day or core operating transactions. Income and expenses. Income tax expense is always listed separately to give you to a total income from continuing operations. Here is a discontinued operations section, which is separate from the continuing operations. This is only applicable if a company has discontinued operations in that time frame. And then you have your earnings per share information on the very bottom. So let's talk about revenues and expenses, because the income statement has what's called revenues and expenses, and it has gains and losses, and they are different. So the income we're talking about continuing operations, reports the revenues and expenses. And the revenues are an inflow of income resulting from providing goods or services to the customers. This is the revenue that we earn as a result of our day-to-day operation or our core operation. Expenses are the outflow of resources that we incur in order to generate said revenue, or they represent the cost of providing the goods and services that are core operation. Alternatively, gains and losses, which also fall under the income from continuing operations, but it's like a subsection, it's one of the subsections, is also income, and it's resource inflow and outflow. However, they're different from revenues or expenses because they don't involve owners. And these really arise when you have a transaction that comes from a non-operating activity, not part of your core operations of your business. They result as things that have happened throughout the year that are outside of your main business. So an example is if you are a clothing store and you sell a piece of equipment for a gain, right, for more than its book value. While selling equipment is not your business, your core operation is selling clothes. So that would be reported as a gain on your income statement rather than a revenue. Another example of a gain is if you have investment income. If assuming you're not an investment company. Investment income would also be a gain. If you settle a lawsuit, some random lawsuit, and you receive income from it, that would be a gain. On the flip side, if you settle a lawsuit and you have to pay out money, that would be a loss. I also want to point out, so the gain, I said the gains are income that arise from non-core operations. Losses are basically outflows of resources also resulting from non-core operation activities, such as you sell the equipment for a loss, or you settle a lawsuit, like I said. I do want to note that restructuring costs are not losses. Restructuring costs are actually considered to be expenses and reported as part of your continuing operating expenses versus your non-operating expenses. The restructuring costs are expenses because they represent outflows of resources in the course of your normal business operations. Here we have, again, our income from continuing operations that we went through before. I just want to kind of point out that we have our sales and cost of sales to get to our gross profit. Then we list out our operating expenses. So again, these are expenses from our day-to-day expenses we incur to run our business. And we get our total operating expenses and operating income. Then we have what's our gains and losses. Even though it says revenue and expense, it falls under other income and expense. Interest revenue and interest expense falls under other income. And then here, for example, is a gain on sale of investment. So this is not an investment company. So it's a peripheral transaction to their day-to-day. I want you to kind of point out this line right here. It says income from continuing operations before income taxes. All of these items are part of your continuing operations. Just the items like from here and above are for your core business and your what's needed to run your day-to-day business, versus from this section is just other transactions. It's part of your continuing operations, but not part of your core business. And then we have our income tax expense separately listed, and income from continuing operations total. And that's, there's two kinds of income statement formats that a company is allowed to file. First is called the single step income statement, and that's when they do not separate the operating income and expenses from the so they list all the revenues and gains together, and all the expenses and losses are together. This makes it a little bit more difficult for the reader of the financial statement to really assess how much income do I have generated from, my actual business versus how much income and expense or gains and losses do I have from other transactions that are not necessarily going to continue to occur year after year. So here you can see for the single step, you have revenues and gains, you have all your sales and your gain on sale for total revenue and gains, and then a list out all the expenses and any losses incurred, which in this situation, we don't have any losses, but if we did, it would be in this section. Again, you always get to the income before income taxes, and income tax expense is always listed on its own line to get to your net income. Versus the multi-step is what we have been talking about this entire time, where we separate out the operating from the other income and from the other income and expenses, the gains and losses we've been talking about. And so just in the multi-step, you do get other pieces of information that the single step does not provide. Gross profit tells you highlights the relationship between your sales revenue and your cost of sales. And then you have what your operating income should, so to see your profitability from your normal day-to-day operations. And then you have your total income before income taxes.